Hello, everyone. Welcome to this webinar, Making Tax Digital, What Musicians Need to Know by the ISM Trust. My name is Ed Phelan. For the purpose of accessibility, I'm a white male with blonde hair, wearing a black t-shirt with a blue and green logo behind me. Please feel free to ask questions using the Q&A function. Introduce yourself in the chat. Let us know where you're tuning in from, and please chat to other participants in the chat box. This is being recorded and will be sent out to you afterwards. We will also send the slides to use during the webinar. Remember, if you are an ISM member, be sure to avail of our tax helpline, our tax discounts, and all of our member benefits. I'm going to hand over now to Sinead Prachka, founder of Musicians Tax Advisor, a specialist in tax and accountancy practice for musicians and music-related businesses. Thank you.
Hello, good afternoon, everybody. It's really nice to see quite a big cohort of people here, and I think and hope you'll find this session useful. The aim is to tackle as much of this really quite big topic as comprehensively as we can, but still allow you all time for questions. So, as Ed said, my name is Sinead. I'm the founder of Musicians Tax Advisor, and really the reason behind the specialism is because I was a musician in a former life. I trained at the Royal College of Music as a singer, and then did a slight about turn and became a chartered tax advisor. But as a consequence, obviously, my area of interest and the side of the business world that I'm really interested in supporting is music and music organizations and really anything to do with the music industry. So with introductions done, I am going to share my slides, and we're going to talk through all things making tax digital. Right, okay, so in the first instance, that QR code will pop up from time to time because there's a couple of different places where there are resources that we want you to take advantage of, and obviously that's one, but don't be worried because that will pop up a couple of different times over the course of the webinar. So the first thing to say is to just talk a little bit about what we're going to cover. We're going to do what is making tax digital. It's actually a bit of a follow-on from a previous digital initiative, which was the process of digitalizing the VAT return back in 2018, 2019. When is it going to affect you? And I'm primarily focused on how this is going to affect freelance musicians. It actually has a bigger impact across a broader spectrum of the population. It's not limited to freelancers necessarily, and obviously not to musicians. But it has a really significant impact on freelance musicians. So that is going to be my focus for the purposes of this webinar. Oops, sorry, I didn't quite mean to go away from that just yet. Why is it happening? So why has it been brought in the first place? What are the rules and requirements? What are the things that you need to be aware of in order to comply with the new HMRC rules? There are some exemptions and exclusions that we can have a little chat about, although I would say don't get too excited because it's quite a narrow remit in terms of exemptions and exclusions, but nevertheless, we'll cover it. It sounds like a slightly vague question, but what does digital mean? Or more specifically, what does digital mean in the context of making sure that you're compliant with this new regime? And lastly, a few kind of hints and tips, things that I hope will help you to get ready for this. So making tax digital for income tax is an intersection of three fundamental areas that are being brought together by HMRC. They want you to digitalize your records. In other words, the income and expenditure transactions and records that you have in your freelance musician business. They want you to make quarterly updates to HMRC, and obviously that is one of the really big changes because it's a change from an annual self-assessment cycle with your tax return. This now becomes a quarterly process, but it doesn't actually completely do away with the need for the tax return. That will still exist. It's not going to be called a self-assessment tax return anymore. It's had a couple of different names over the last year, 18 months. At the moment, it's being called the final declaration. I'm going to go with that for now. but really, for your purposes as a freelancer who's sort of trying to make sure that you get on top of this, you could probably safely enough think of it as the tax return part of this change. And the reason sole traders and landlords are stuck in that circle in the middle of my screen is because this change is affecting sole traders, in other words, self-employed people, and landlords in the first instance. Those are the two kind of demographics that are going to be affected by MTD for income tax, which is Making Tax Digital for Income Tax. It's abbreviated to MTD for income tax. Okay, so that's very broadly speaking, sort of the what is it. The when is it happening is, in truth, it's really quite soon now for this first tranche of people over here that I'm looking at in April 2026. So that is, what are we now, sort of 6 months away from that point, and that is when any landlords or sole traders, self-employed, who have qualifying income in excess of £50,000 are going to be brought into this new regime from April 2026. It means your 26-27 tax return is within the remit of Making Tax Digital for income tax. From April 2027, that threshold of £50,000 of qualifying income is going to drop down to £30,000. So obviously we're catching a much bigger net of self-employeds at that point. And then last, it drops down to £20,000 in April 2028. Now, we're going to go on and talk in a bit more detail on the next slide about what is qualifying income. This is the key phrase that I need us to be all aware of, because qualifying income is not what you would think of traditionally, maybe, where you tend to think of your income as your taxable income, whatever is reported within the self-employment pages of your self-assessment tax return. Qualifying income, and I will come back and reiterate this at another point just so that we're all really clear about it, but qualifying income, it's really important that people understand the distinction on that one, because it's income before expenses. So if we go back and we think about those three big thresholds again, you're talking about £50,000 of income before expenses, 30,000 income before expenses, and then £20,000 of income before expenses. And obviously that sort of, again, broadens that net of people that are going to be caught up in this. I'm not going to spend an awful lot of time on the why, but just because it is something that people sort of, I think it helps in a way to understand why these changes are being foisted on us. So I'm just going to explain it very, very briefly. So HMRC at the moment use an old, I'm not a techie person, but they use a kind of a computer system, which was originally built in the 80s. So yeah, it's 40 years old and it's really creaking and it's very soon going to collapse, basically. So HMRC are trying to get ahead of that and to make sure that they build a new system which is going to be fit for purpose, which looks forward and kind of anticipates what we're going to need as taxpayers and as a society in the future. So part of the remit in terms of the digital side of all of this is looking forward and making sure that we're keeping an eye on the future in terms of how we report to HMRC. Some of it is just a very practical background, that is that we need to move forward because the existing system that they've got in place just can't support us anymore as taxpayers. And by no means least, the intention behind this is that it's going to do this really important thing, that it's going to close the tax gap. The idea behind that is that it's going to reduce errors and minimise areas where, for one reason or another, there's a shortfall in the tax coffers, the tax take to the government. So that is the hope and the intention behind it. Whether it succeeds or not is maybe a conversation for another day. So I'm going to go back now and talk a little bit more carefully about qualifying income, because this is really the sort of the key point where everything else kind of moves from there, because that's what's going to decide when you're mandated into this new system. So when you're thinking about your qualifying income, obviously for the purposes of today, because I think it's most of what you'll be interested in, we're talking about those who are self-employed freelancers. But in actual fact, HMRC are also looking at property income as well as self-employed income. And not only that, they're looking at property income both in the UK and abroad. So, for example, if you are a freelance musician with, let's say, £40,000 of music-related income in your music business, but you're also a landlord who rents out a flat and has, let's say, £12,000 of property income, the combination of those two sources of income trips you over that £50,000 qualifying boundary, because you now have £52,000 of qualifying income, and that determines the fact that you're going to be brought in to Making Tax Digital as of April 2026. I said it before, but it's worth repeating. It's turnover, it's your income before expenses. In both cases, both property and trading, they both look at turnover. And as we said a minute ago, it's an aggregated total. So it looks at the various sources of income you might have, both trading and property in the UK or abroad, and it aggregates those totals to determine whether you have met the qualifying threshold or not. Okay, so you probably already have a vague idea of when that might happen. And I've just remembered I was going to ask Ella to put up a poll for us about this, which I'm going to come back to in right now. I think actually, to be fair, it's quite difficult for some of you to determine, but it'd be really interesting to see. And we're going to talk a bit more about how you can be certain in a second. Great. Is that it, Ella? Do you need to click this away, or shall I do it? Don't want to make a mess of that. I might try and minimize it. There we go. I'm going to get rid of that. So that poll was really interesting, actually, because I would say the gap between the various times at which people are going to be brought in, there's less discrepancy between those of you who are going to be affected in April 26 versus April 27 and 28 than I would have thought. I think, truthfully, the government, the expectation is that there's going to be a relatively small cohort in April 2026, a much bigger cohort in April 27. That's probably the one that people think is going to be the big one, and then a little bit smaller again in April 2028. But actually, from the results that I was seeing on that poll, it was relatively evenly split. Still the April 27 more heavily weighted, but not massively different compared to those of you affected in April 26 and April 28. And this is the problem. I think we're looking at it here on the screen, is that some of you will not yet have completed your self-assessment tax return for 24-25. And that is the kind of document, or that's the key piece of information that HMRC need in order to determine whether you are mandated in or not. So it's that tax return that's going to trigger the requirement to be in MTD for income tax as of April 2026. And of course, if you leave it right till the end of the deadline, so let's say you leave it till January 2026, by the time you've realized that yes, your qualifying income is over the threshold, you have a relatively narrow window of time to get yourself organized, all of which is to say, do get your tax return in as quickly as possible, because forewarned is forearmed, or whatever the expression is. And then looking at the later dates, if you're going to be, if you trip over 30,000 as your threshold in the 25-26 tax return, that will bring you in April 27. If your qualifying income exceeds £20,000 in 26-27's self-assessment tax return, then you will be brought into MTD in April 2028. So those are the deadlines to really, really be aware of. Okay. So let's just go. Here we go. So I'm just going to check I haven't missed. No, I haven't. Okay. There's a few little other details then to just cover as part of the when is this going to hit me question. The first is, for those of you who are relatively new to self-employment, you've just started your self-employment business, what HMRC are going to do is they are going to look at whatever number of months you've been trading, and then they're going to annualize that. They're going to take that as an annual equivalent. So if you've only traded for 4 months worth of the 24-25 tax return, HMRC are going to look at your income total there, and they are going to extrapolate what that would have been over a 12-month period if you'd had a full 12 months. And if that's going to be, at that point, more than £50,000 of qualifying income, then in you come. And just to be absolutely certain about where HMRC are looking to grab this data, they're looking at your self-employment pages, your UK land and property pages, and your foreign property pages. It's those 3 sources that HMRC look to. Now, there has been a campaign, an information campaign from HMRC that has already gone out. And I would say, I think it's a relatively slow start to that campaign. And in fact, Ella, I don't know whether it's too late to go back and do the very, very first poll that we were going to do, which is, I would be really interested to know, yes, thank you so much, how many of you have actually kind of been made aware of this, I mean, prior to this ISM webinar, obviously. Okay. Great. So Ella, I think you've shared those results, have you? It's hard for me to tell because I'm not sure I'm getting exactly the same screen as everybody else. I'm going to give that like 5 more seconds. And then I'm going to do a spoiler alert just in case people are not seeing what I'm seeing. But what I'm looking at is that only 20% of you feel like you've had a lot of information, and just under 40% of you have had some, and 45-ish have had, you know, a bit more, all of which is to say, I think that's not enough. I think it's fair enough to say that with a big change like this, you could have done with a little bit more heads up. Nevertheless, lots of bodies and the HMRC and people like ISM and all kinds of institutes are trying to ensure that you are now given the information you need to plan ahead. And one of the ways that HMRC are going to do that is anticipating the fact that some of you won't have filed your 24-25 self-assessment return yet. They're looking back at your 23-24 to try and sort of get a sense of whether, you know, if you've got a reasonably typical or stable income pattern, does that indicate that you're likely to be brought in April 26? So you might even have had a letter already, despite the fact that you've not yet filed that return. But you should definitely be getting a letter very soon if you have not yet. All right. So now we're going to talk briefly about exemptions, but I really don't want anybody to get very excited about this because they are a bit like hen's teeth from everything I understand. So if you have no national insurance number, which, I mean, to be honest, would typically mean because you're too young or because you're not a UK resident and a UK tax resident, then obviously they can't bring you into MTD for income tax because the entire data collection system hinges on your national insurance number. That's what everything falls away from. So if you don't have one of those, you're not going to be mandated in. Digitally excluded is the big one. And I've left it in the middle, and actually we're going to talk about that in more detail in the next slide, to what constitutes digitally excluded. And last but not least, non-UK resident entertainers. Now, I've put that one in because obviously as musicians, it may well be that some of you fall into that category, you're sort of entertainers, but truthfully, the chances of you being non-UK resident entertainer that nevertheless has sufficient, who has no other UK income and therefore doesn't have to comply with this, I would say is relatively unlikely. It's really designed to catch those kind of one-off artists that come to the UK, do a great big show or a tour, they're taxed as a foreign artist, and then they head off again. It's not really going to be useful, even for those of you who might not be UK tax resident in priority. You know, you might have a dual residency, for example. And so UK might not be your primary tax base, but nevertheless, if you're here on this webinar, the chances are you have UK source income. And if you have UK source income, even as a UK non-resident, then you're going to, broadly speaking, you get a 1-year delay, but broadly speaking, you are going to get pulled into this scheme. So let's talk about the middle one, because this is the one that people are going to be most focused on, I think. There are kind of these two areas that HMRC are willing to consider in terms of how to define someone who is digitally excluded. First one is relatively clear. Is it incompatible with your religious beliefs? So, for example, fundamentally, your faith is not going to support using technology, for example, using a computer regularly, or transferring data digitally. Those kind of exclusions would really only apply because it's a fundamental cornerstone in your faith that precludes you from taking part. But so that's one option. This middle one here, digitally excluded, where it's not reasonably practicable because of age, disability, location, or some other reason. So what they're really trying to capture here is that if you have a disability that prevents you from filing your tax return digitally, that would be a qualifying exemption. If, for example, you live in an area of the UK where your broadband service and your internet and connectivity is so poor that you cannot reasonably rely on it, excuse me, to make your digital returns each quarter, then that would also follow. And the age one is a little bit of a grey area, because age doesn't necessarily determine, as we all know, your ability to interact digitally or not. But they're trying to kind of allow for the fact that an older population are perhaps going to be a bit more intimidated by the idea of getting on board with the digital record keeping. You have to apply for the exemption, and this is a source of some kind of slight despair and eye rolling among my community of fellow accountants. In order to apply for your digital exemption, reasonably enough, it cannot be done online, because that would entirely contradict the fact that you're saying you're digitally excluded. So it necessarily has to be a written application or a telephone application to HMRC. And HMRC struggle to keep up with some of these forms of communication. They're, as a general rule, they're behind on their communication, particularly paper communication. So there's some concern that this is going to be really difficult to manage. It's also a very, very new part of this whole scheme. The application system only opened in October. That's a matter of a couple of weeks ago. And as far as I know personally at this stage, I'm in a group that is monitoring this kind of thing, and thus far we haven't seen any successful applications, which is not to say that if you feel that you qualify as digitally excluded, you shouldn't go ahead and make an application. You absolutely should, but it is also to say that HMRC will most likely write back and say, we need to kind of review your particular scenario, and in the meantime you should assume that you're being brought in. And I would say that's probably the way to proceed, is assume that you will not be granted an exclusion, and then if you are, then great, but make your plans as if you're going to be brought in, would be my recommendation. And there we go. Okay, so I'm just going to have a quick look at the time. I'm not going to manage. Oh yeah, there it is. Okay. Quarterly updates. Okay, so this is really just the practicalities of the when do you need to do these reports to HMRC. So for those of you who are familiar with the VAT regime, it's broadly speaking a bit like that. It's 4-quarter returns. Each quarter is a 3-month period reporting your income and expenses. Its first quarter starts on the 6th of April 2026 and runs to the 5th of July. And you have roughly 5 weeks to pull that information together and to submit it in a quarterly update to HMRC by the 7th of August. And then each of the following quarters follow along as you'd expect. The things I want to draw your attention to are these little bits of extra information down here, which is that it's a cumulative process. So if you miss out some information, because for one reason or another you didn't have the data in the first quarter, you can update it and include it in your second quarter's return to HMRC. So it builds your picture over the course of the year. The categories of income and expenditure are the same as the categories that you set things out in for your current self-employment pages. So expenses break out into the same categories as you're used to from that. And there are certain accounting and tax adjustments that are done every year in the self-assessment return for things like maybe capital equipment, for example, which goes through in the capital allowances section, or for example, a personal usage element of things like cars and mobile phones. And you have a choice here to either make the adjustment each quarter and put through the sort of finalized tax deductible figure, if you like, of that expense, or to just put through the value that you have in that quarter and do your tax adjustments as part of your final declaration. Okay, final declaration, which is, let's just call it the tax return. It's what we think of as the tax return, and it will pull in all of the same sorts of information that we grab in the tax return now. So PAYE income, bank interest, savings income, gift aid, student loan, pensions, all of those kind of things will go through as part of your final declaration. What's really, really important to know about this, and this is really the clangor, it's quite a shocking thing to learn, is that once you're brought into MTD for income tax, and once you've started, if you're brought in April 2026, for example, once you're underway, your government gateway portal is no longer available to you. It's essentially going to be sort of closed off. And it means you have absolutely no way other than through some kind of third-party software to complete this final declaration. You won't be able to go on your existing government gateway, log in and complete this 5th and final declaration part. You'll have to find another method. And that's really one of the big reasons to start thinking now as soon as possible and get yourself organized so that you can think ahead to that requirement in the context of what choice you're making about your 4 quarterly updates and the software that you might want to think about for that. Small little details here, well, not that small really. If it's easier for you to elect for the 1st of April to the 30th of June, for example, calendar quarters, that's absolutely fine. You make that choice in your first quarterly update next year, and then HMRC will expect it from then on. That's no problem. But if you have more than one source of self-employment, now when I say more than one source of self-employment, I mean 2 distinct trades. So you're used to filing 2 separate self-employment pages each year in your tax return. Then the expectation is that you will be filing 2 separate sets of quarterly updates. And that is quite a significant thing to be aware of. And, you know, potentially if you also have land and property income, for example, you're a landlord with 2 separate self-employments, now you're looking at 3 quarterly updates every quarter, plus 1 final declaration at the end of the year. Right, that's a lot about the logistics. Before I go into this next bit, I'm just going to go back so we can sit on this slide for just a little bit longer. Ella, I can see there are some questions coming through, and I just want to kind of open up the option if we're getting a lot of similar questions at this stage, because it's a lot of technical knowledge. I'd be very happy to just kind of give everybody a chance to regroup if we need to. Just let me know.
I would say I've compiled a few of them so we can go back near the end.
Yeah, but you think we crack on?
Yeah, I think
Good.
so, because you're answering some of the questions as they come in as well.
Grand, okie dokie, let's keep going in that case. So, qualifying income, let's say you're towards the tail end of your career and your income is going to start dropping now over the next couple of years. This is probably the bit you want to really pay attention to. It has to fall below the relevant threshold for that year for 3 consecutive years before you can pull yourself back out of MTD for income tax. So if you're going to be mandated in at April 2026 because your qualifying income in 24-25 is over the threshold, but then it begins to drop over the next couple of years, you actually have to stay within MTD for income tax for 3 consecutive years in order before you can then pull yourself back out. Okay, which means in theory you would be looking at sticking within that system until the 29-30 tax year, which feels a long way away. If it's utterly bonkers for you to be coming into this because you're about to retire and you know this is the case, and although you have qualifying income which breaches the threshold in 24-25, but you know you're on the cusp of retirement, then again, you can make that case to HMRC that it just is not sensible to start MTD for income tax, and they are looking at those on a case-by-case basis. Right, I put a slightly kind of rainbow feel to this slide because it's the bit where HMRC have recognised that this is a lot, and they're trying to give you some easements, as they're called, in a couple of places. And some of these really will make life easier, so you can take heart. The first one is simplified expenses. So that is where, for example, you claim mileage instead of actual expenses on your car usage if you use your car for work, or you can claim a use of home cost under simplified expenses. They continue to be usable, as does the trading allowance, which is the flat rate £1,000 allowance or sort of expense allowance. And if you know that you're going to claim that against your self-employed income, then you don't actually have to report any expenses at all in your quarterly update. So if you know you're going to use simplified expenses or the trading allowance when the kind of final analysis comes at the end of the year in your final declaration, then you can just report your income each quarter, and you don't need to claim the expenses or quantify or notify the expenses. But of course, it does mean that when it comes to the final declaration, you will only be putting through either the trading allowance or simplified expenses on your tax return rather than actual expenses. And that is often a very useful shortcut for musicians. But of course, if your expenses are significant, then it's not usually terribly attractive from a tax point of view. Nevertheless, it's available. Jointly owned property, I'm not going to talk an awful lot about in this webinar because we have so many other things to talk about for self-employed, but I will just highlight that there are a couple of different easements available to you there. So if you're a landlord or you have a rental property as an investment that you share with a partner, there are some things in place there to make the reporting on that a little bit easier. But the big principle behind is each of you as land and property income owners have to report quarterly your income from that property, but one of you can report all the details and the other can just report income each quarter. So it's a simplified version, and then you catch up at the end of the year. 3-line accounts, I think, is the one that's going to be most interesting and most useful for those of you listening here today, and that is that if the source of your income, so your freelance musician business, let's say for today, is less than the VAT threshold, which is £90,000, then you can submit what's called 3-line accounts each quarter. Now, what a 3-line account means is it's the total income figure and the total expense figure, which of course gives you a total profit figure, and that's why it's called 3-line accounts. So you don't have to give the breakdown of all the different income transactions and all the different expense transactions. You can literally just report the global total of in, global total of expense, and that leaves the global net profit figure. And that does, in theory, simplify things for you. It just remains to be seen as to whether that's useful for you or not. It's a very personal choice, but it would, I think, probably be something it's definitely something to be aware of because it might be useful. There are a number of easements for retailers, which again, it's too much down the rabbit hole to do that today, so I'm going to leave it, but do have a look if it affects you. And likewise, there's also a recognition that some choices have to be made about whether some of your income or your expenditure is capital in nature, sort of in big investments into your business or sales of capital items from your business. And there are choices about how you recognize that to try and make the record keeping a little bit easier. So some of this slide, I would say, is maybe a little techie, and it's more to make you aware of the fact that you can go and find more information if you need to, if it's relevant to you. The one I think that's universally useful is the 3-line accounts, and the fact that if you know you're going to use simplified expenses or the trading allowance, you can just go straight to that option. So keep those two relaxations in mind. I know I've been banging on about this one. I clearly wanted to do that again. So there's yet another slide. Although this is a new piece of information, I think. The deadline remains the 31st of January following the end of the tax year. So that 5th and final declaration for your 26-27 tax return, which is the first one you're doing under MTD for income tax. So that tax year will end on the 5th of April 2027, and your final declaration will be due on the 31st of January 2028, which is the same cycle of tax deadlines that you're used to. And the other key aspect here is that HMRC will do the calculation for you as part of this process. So when you've submitted everything in this 5th and final kind of update to them, they will generate a tax calculation for you based on all the data you've given them. You then approve that or agree with that, and then that gets submitted, and that kind of signs off the whole process. For those of you who use the HMRC software in the Government Gateway at the moment, that's not vastly different because HMRC generates the tax calculation in that Government Gateway software as well. But for people who use third-party software at the moment, that is a bit of a difference. Okay, so I'm just going to give myself a little sip of water here and let you have a quick look at what a digital link actually is. And actually, maybe now's a good time to do a slide because we're sort of sliding into software. And so, Ella, do you want to see maybe if we have an indicator of how many listeners use software at the moment? Yes. Oof. That's quite the learning curve then, isn't it? I think for everybody, which I think is to be fair, is more or less what's expected, sort of how I would understand it, how I anticipated it. But nevertheless, it's going to be a big change, I know. So let's talk about what digital links actually mean. And I always think it's actually much easier to talk about what it's not than some of these very technical terms over here. So let's just focus on this corner over here, which is what is not a digital link for a quarterly update or for a new style tax return. Manually typing anything in is not considered a digital link. And that is why the existing Government Gateway is going to be closed down. It's because if you think about it, essentially that gateway piece of software that you might use to submit your tax return each year, fundamentally, that's a form. And you're typing in the numbers into that form and then submitting it to HMRC. And that is not digital because there is nothing linking that number back to some sort of a digital record. And that is why that's no longer acceptable, and in turn why that gateway gets shut down once you're brought into MTD for income tax. Obviously, that also means pen and paper. For those of you who might still submit a pen and paper tax return by the earlier deadline each year, that's also no longer going to be an option. What is considered a digital link is emailing a spreadsheet. For example, you might email a spreadsheet, which is a download, for example, of your bank transactions to your accountant, and then your accountant uploads it into software and sends it off to HMRC. That is a digital link. Or you might have a bank which is feeding into cloud accounting software, and from there you prepare your quarterly update and you send it into HMRC. Excuse me, that is also a digital link because it starts with an initial transaction and the whole journey into HMRC is a digital journey. And that is the really important part of the definition of digital. A portable device, for example, where you would download your data onto like a USB stick or something like that, is also allowable. And I'll be honest, these two last bullet points are a little bit above my pay grade in terms of tech. But nevertheless, they're sort of talking about one tech system, IT system, talking to another. And again, as you'd expect, that's digital. So what HMRC are looking for is they're looking for a piece of data which has these three fundamental pieces of information inside them: the date it happened, the amount, and the category in terms of income or expenditure. And even within expenditure, it can be broken down into the types of expenditure you're used to breaking down into for your self-assessment return each year. That constitutes a digital record. Okay, so again, being mindful of the time, I'm going to crack on now with some like what to do's, essential kind of things to think about to try and get yourself ready. By a million miles, the biggest thing and the most important thing is to think about simplifying your banking. As a self-employed sole trader musician, it's absolutely fine. You're perfectly entitled to have a bank account which is a mixed use bank account. In other words, it's a personal account or a joint account, as well as your account that receives your income, and you use it to buy any expenses for your business. I would really recommend that you now think to split that out and you set up a dedicated business bank account. It doesn't have to be a business bank account in the way that it does if you're a limited company. It has to be a dedicated, separate bank account that you use for your business, and that would be considered a business bank account. The reason for that is it means you could get to the end of each quarter and just download your transactions. And that would be the record of your income and expenditure for that quarter. You could connect that bank account to a piece of software, and that would be your connection for a digital report into HMRC. It's the gateway into making sure that there is an easy flow of the right data, not too much and not too little, into HMRC. Consider any exemptions, and if you think you are eligible, get on the phone or write that letter as soon as possible. We're going to talk a little bit in a minute about your software choices, but obviously now is the time to really think about, do you want to get to grips with some software? And if you think you are going to go down that route, there's not a huge amount of choice, there's some. Now is the time to start shopping around, because they do work differently and there are choices to be made. And if you're feeling very gung-ho, you could consider joining the beta phase with HMRC, which means you could enter the MTD testing phase ahead of when you absolutely have to. You could enter it this year, for example, and catch up on the quarters that you've missed, and do the next one is the Q3 return, and you could do that and catch up because it's cumulative on the Q1 and Q2 that you've missed. And that would give you the chance to sort of see how the whole system works, do a little bit of practicing. There's no penalties for late submissions. There's some extra support available with HMRC. There are good reasons to do the testing if you're up for it. So this is a very high level look at some of the softwares, because it's a list as long as my arm. And the main thing I wanted to say about the software is that it's still very much being thrashed out. I mean, literally today, one of the fundamental pieces of software that I'm looking at, for example, only released their pricing this afternoon. So it's really a moving picture still, which is why there's no definitive answers on this yet. But when you're looking at software, what you need to be looking at is, will it do the quarterly update as well as the final declaration? Not all of them will. You can be HMRC compliant software just by virtue of being able to do the quarterly updates, even though you can't do the final declaration. So will it do that? Don't just look at the promo, freebie, cheapy phases. Look at what you'll pay long term, because there's a learning curve, and once you've invested in that, you don't then want to find that it's beyond your price bracket. And look at what you get for your money, because like everything, there's greater and lesser degrees of functionality. But there are a few things to look out for in particular. Software will, broadly speaking, break down into, there's a kind of a new kid on the block, but so I'm going to talk about three categories. It was really, until a couple of days ago, it was two. Now it's three. Bridging software would enable you to continue to, or start to, keep your records on a spreadsheet and then connect that spreadsheet to bridging software and use that to push your data into HMRC. And that is absolutely feasible. TaxCalc are the ones who came out with their pricing this afternoon. Absolute is another one I'd recommend you have a look at. My only hesitation with bridging software is that it tends to be focused more on a user experience that's with the accountant in mind and less so with the freelancer in mind. So sometimes the kind of user interface is not quite as nice, and it's a little bit techier, but it is almost always cheaper. And if you're a spreadsheet fan, then that is definitely the way to go. So do have a look at those. There's lots and lots of cloud accounting software, not all of which has been sort of approved by HMRC. There is a link that we'll send, if it's not in a later slide, we'll make sure that you get it, where you can go onto HMRC and see what's been approved and made it through its testing phases and so forth, and what's still a work in progress. And so do have a look at that list, go through that tool on HMRC, and we'll absolutely make sure you have the links for that. But one of the ones I want to draw your attention to is Free Agent, because it is free if you have a NatWest Group bank account. And that is a really nice little bit of add-on kit if you do. And the other one I'd like to draw your attention to is ClearBooks, which is free, and also well worth a look. And they really do all have pros and cons to do with them. I would also absolutely speak to your accountant if you have one. If you do your own taxes, then obviously it's entirely down to you as to what you choose. But if you're working with somebody, a bookkeeper or an accountant, make sure you cross-reference your choice with their choice, because they will have an opinion. So do try and work with that. And then the new kid on the block is banking. Suddenly there's been an influx of banks in the last couple of weeks who've made announcements that say you can now file an MTD quarterly update through that bank. So Monzo have announced, I think Tide have, I'm slightly less certain about them, Starling have, and in each case, it's probably not quite as free as it looks, because you'll be paying for the bank account, but it would look at what it would allow you to do from an MTD quarterly update point of view, and see if that ticks the box for you. And be mindful of the fact that the banks almost necessarily won't be able to do your final declaration, because they're your bank. It's not a piece of tax software. It's not designed to be tax software. So final stages, really. It's been a lot of quite dense information, and I'm really keen to try and get some of your questions in if we can. First, I'm going to do a little plug about who we are. We, so Musicians Tax Advisor, have actually set up a resource page, a dedicated web page, all about MTD for income tax. It's there to try and support freelance musicians and musicians in general. It's got videos, it's got blog posts, it's soon going to have a kind of a shopping list software matrix of some sort when I can put it together. And it has a WhatsApp group for peer support, which is really, I find, for example, as an accountant, that the peer support that I've engaged in as far as this new change is concerned has been really invaluable. So I'd really recommend you think about that. So you can join the WhatsApp group, which we run and we moderate it, but it's really designed for peer support, and look at the other resources that are available there. You should, of course, go to the ISM Trust, whose MTD resource page is constantly building. And as each new bit of resource gets added, that becomes more and more a trusted source. And that's something that's really important, is to go to a trusted source for your information. There's a lot out there on YouTube, for example, including us, some of which can be more trusted than others. So just vet your sources carefully. And last but not least, of course, .gov.uk, where you'll find links to all kinds of different bits, an explanation of why, a link to the help you choose your software tool, where you can put in the parameters you're looking for, and it should give you a list of what meets your criteria, which is the link we're going to send you anyway also, but you can go and find it directly there. There's lots of resources to be had from those places. How do I go on to the next bit? I'll come to that at the end. There is life beyond MTD, believe it or not. Right, I think it's time for questions.
Thanks, Sinead. That was fantastic. And I think it helps to take some of the mystery out of Making Tax Digital. We have a lot of questions. A lot of them are covering software, which we discussed a bit. So we'll try and get through as much as possible in the next few minutes.
Yeah.
One here from Emma. Does qualifying income include employed income you receive through PAYE, or is it only self-employed income that qualifies for MTD?
Oh, Emma, I'm so glad you asked that. I thought I had a slide on this, but actually, clearly I didn't. I wanted to really drive that point home. So thank you for asking. No, it does not. So qualifying income does not include PAYE income. It does not include pension income. It does not include savings income. It really only looks at self-employed income and land and property income. Now, the land and property extends to foreign land and property as well, but it's really those two key sources and nothing else that tips you into the qualifying income threshold.
Great. We had a question about pensions as well, so that's great.
Yeah.
We have a mixture here. So can I still use an accountant? And do you think accountant fees are going to soar for sole traders with multiple submissions instead of one?
I would, I'm going to answer the second question first and say I would love to tell you that they are not, but yes, they are going to. I can really truthfully tell you, because I'm part of this group, that none of my accountant peers want to see freelancers punished by having to comply with this new legislation, by suddenly having a disproportionate amount of accountancy fees. So yes, they will go up, but they will also be within what any decent accountant feels they can manage, so that they can still provide you with a safe and compliant and reliable and accurate service without trying to just kind of cream any money off the top. Nobody wants to do that. What I can tell you is the hours and hours and hours and hours and hours that accountants are putting in to trying to support their freelancer clients is like that big iceberg picture, only even bigger. Which is, sounds like a poor me. It's not designed as a poor me, but it's like anything. You're paying for something that you probably don't maybe always see is happening, but there is an enormous amount of work going on to support the freelance community, and the community in general that are affected by this. And yes, it's going to have to be paid for in some way or another. And I can't speak for anybody else, but I can speak for a crowd of accountants that I'm part of, who have integrity and don't want to see people shafted. But we are working flat out to make it happen.
And
Oh, I
slightly
forgot the
on
first
that,
bit of the question. What
go
was the
for it,
first bit
sorry.
again?
It was, can I use an accountant?
Yeah, you absolutely can. And actually, it is worth going back to that for a second. You absolutely can, of course, use an accountant. But not only that, you could also use, if it was right for your business, a separate bookkeeper and accountant. And the reason you might want to think about doing that is, let's say you have somebody who's good on the books, like you have a family member who feels confident with doing your books on a quarterly update, but they're not a tax expert. So they don't want to be responsible for the final tax return part. HMRC have now put in place a system where you can have more than one kind of authorized helper with you. So you can have a digital handshake, is called, between your bookkeeper and your accountant and you, so that you can kind of allocate the work in a cost efficient way and in a time efficient way. So yes, to answer the first part of the question, you absolutely can. But not only that, you could also think of prioritizing who the professionals are that you look to for support.
Great. We have one from Clara here. Can you include the cost of software as an allowable expense?
Most definitely. Yeah, that's just a clear old yes.
And a follow-up one here, it's the same with accountancy fees.
Yes.
Brilliant. We go. What happens if your self-employed income drops below 20,000 a year?
Well, as we mentioned, if it drops below 20,000 a year, then in theory you fall below the qualifying threshold, but it has to consistently stay below. Let's say it drops below at the point where you'd normally come in. So we're talking a couple of years hence, you've tipped over 20 the year before, but then you've dropped again. You have to stay below the 20 for 3 consecutive years before you can come back out.
Great. Is there a way to use your own spreadsheet bookkeeping format and link that to HMRC? We've slightly touched on.
We've sort of touched on, I would say, There's no way to push your spreadsheet as a standalone spreadsheet into HMRC. You have to have an interface, which is this bridging software. Now, bridging software is it's not entirely formulaic, like there will be the ability to kind of tailor it, as my understanding is. I haven't practiced a lot with digital software with the bridging bit yet. But I think there is scope to kind of tweak it so that it's intuitive to you, but nevertheless still bridges correctly and then pushes on into HMRC. But you will need that bridge from yours to HMRC.
From Helen here, are there penalties if the final declaration identifies errors in the quarterly updates?
No, well, there are the regime of, I'm glad you asked about penalties because we didn't touch on that really. The regime of penalties fundamentally, as far as errors, stays the same. There is a whole system in place to deal with errors. So like normal errors, a mistake that you've made honestly and you then immediately try to fix, HMRC are, you know, in the context of this anyway, are going to be flexible about that. Certainly there's no penalty. And the other thing to keep in mind is that it's a cumulative process, as I mentioned. So if you make a mistake in Q2, but you correct it in Q3, then you've caught yourself up, then there's no problem with that error. Going to the penalties part of the question, that is changing quite a bit though. And instead of, as we now have this £100 flat rate penalty if you miss, for example, the tax deadline, it's going to be done on a points system. So every quarterly update that is late gets 1 penalty point. Once you've reached a threshold of 4 penalty points, you get a £200 fine. So 200 rather than the existing 100, and it's after your 4 points. And once you've triggered that initial first penalty, if you have one more late return, that doubles. You get another £200 penalty fine. So there are quite punitive relative to what we have now, penalties for missing submissions and late submissions, but the error system, broadly speaking, stays as it is.
Great. Just because there's a few people asking for a bit of clarity on this. So if income is below 20,000 for 3 consecutive years, then we continue with our current tax return process.
Yeah, so I'm going to go from today to make it really clear. If your income in the 24-25 tax return is below £20,000, your qualifying income, then you're not going to be brought in. And let's say it stays the same for the next 3 years. If you're below, then you're just not going to be brought in at all. But if your income is £22,000 in the 24, 26, 27, I think it is, tax return. I'll have to go back to my slide to be absolutely sure on the dates, but I'm pretty sure it's 26, 27. If it's above 20,000 in that one, then you've triggered the qualifying threshold for that tax return. You're brought in the following April, and then you have to stay below 20 again to get back out again. So by now you're talking about kind of 20, 31, 32 or something crazy to come back out.
Great. Can you clarify if you use this from Hamish? Can you clarify if you use banking software, e.g. Sterling Monzo, that these are only able to handle the quarterly updates and you would still need to look at the bridging software for the final declaration?
Yes, Hamish, absolutely. And it's something that's really an important part of your kind of shopping list, if you like, when you're looking at software. If you think about it, there's logic to it, because Tide and Starling and Monzo, they couldn't possibly do a tax return for you. They are not tax softwares. They would have to have all of the functionality that a tax return can offer, all the different sources of income. So just even logically, there's no way they can do it, but they are offering to do the quarterly updates. I don't know anybody who's tested it yet, not even within the group, my peer group. But I will probably ask about that actually, and I'll report back. And again, it's the kind of thing that we're putting out blogs and social media posts, and we're trying, because everything is moving all the time, we're trying to tell you things as we learn, because we are still learning very much.
And probably time for one more here from Yuri. What happens if you only have a physical receipt? How do I get that data into the system?
I think, Yuri, you might mean for something that you paid cash for. I guess that's probably what you mean. And in a system like that, well, Two things. Try not to do that for a start. Just get your bank account and use your debit card. That's the easiest way. But for a system like that, I would, and let's say you have accounting software, I would take a photograph of it and push that into your accounting software. Now you have a digital record, or put it into your spreadsheet, and that spreadsheet gets bridged to HMRC, and that would be sufficient as a digital record. I take the point, it seems slightly bonkers because it does start life as a piece of paper and a cash transaction, but I suppose you have to turn it into a digital record and then it continues its journey from there.
Great. Thanks a million, Sinead. Unfortunately, we've ran out of time. Sorry if I didn't get to your question. What I will do, I will take note of any questions we haven't answered, and we can answer them and send them out in an email list. And the ISM will be building more resources for Making Tax Digital anyway, where we hope to have all the answers to these questions and more. Thanks, Sinead, for the great presentation and fantastic.
Pleasure.
Do check out her work and all of her resources as shown here. Do you have one more slide you wanted to show, Sinead, actually, before I...
Oh, yes, I think it was this. I mean, it's just another way to, no, going the other way, sorry. No, that's, don't worry about it. I think it'll come as part of the slide pack. It was really just to say there is life beyond MTD for income tax. And if you join our newsletter, you'll get the odd bit of tax information and helpful hints that don't have anything to do with MTD, just to spice it up a bit.
Great. Do join that newsletter. The ISM members also get access to a tax helpline and discounts on accountancy and tax advice. So do check that out. Our next webinar will be the 26th of November. It's going to be Vocal Health, Protecting Your Voice in Daily Practice. Thanks, Ella and Sinead. And this webinar will be sent out afterwards. If you have any questions, please do get in touch at membership@ism.org. And thank you, everybody, for attending.
Thank you so much, everybody.